From downtown Milwaukee, welcome to Money Talk with Bob Landaas. Each week, professional advisors from Landaas & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for November 8th, 2024. Let's check the calendar. Well, the Packers have a bye week. The struggling Milwaukee Bucks are in New York with the Knicks, and they're back home Sunday with the Celtics. The Daily Show's Josh Johnson is at the Pabst Theater Saturday, and there are a bunch of Veterans Day celebrations throughout the area. Make sure you thank a vet. Okay, here we go. Is it any wonder TGI Fridays is filing for bankruptcy? It won't have enough cash if customers redeem $50 million in outstanding gift cards, and their cards don't expire. That's a gift that might not keep on giving. In Oregon, an ambulance hit a bicyclist, then conveniently rushed him to the hospital. Then just as conveniently, stuck the bicyclist with an $1,800 bill. That's according to the lawsuit. A lawsuit, yeah, you think? And finally, an Indian publication, The Hindu, reported that a man died after he accepted a challenge to sit on a container which had a box full of lit fireworks in it. He did it to win an auto rickshaw. You might say he sat on a buttload of firecrackers, but it gets worse. The publication said the horrific incident was captured on a neighbor's Ring camera. That's the downside of spying on your neighbors, and that's why we don't allow cameras here in the studio. On the podcast today, we have Mike Helzel, Art Rothschild, Tom Pappenfuss, and crunching the numbers, here's Joel Dreesing.
Thanks, Max. I don't know if the story gets worse or it's your jokes that get worse. But
There's one
yeah,
in every,
we're just groaning, they're groaners.
there's one in every crowd.
Yeah. So nothing to groan about with the stock market this week, though. Our numbers went up. We had the NASDAQ added 1,047 points, or 5.7%, to end the week at 19,287. The S&P 500 was up 267 points, or 4.7%, to end at 5996. And the Dow Jones Industrial Average was up 1937, or 4.6%, to end at 43,989. The 10-year U.S. Treasury was down 5 percentage points, 0.5 of a percentage point, to end at 3.1%, and started the year at 3.87%. The other indexes we looked at, the NASDAQ so far this year, including dividends, is up more than 29%. The S&P 500, including dividends, is up 27%, and the Dow Jones Industrial Average is up more than 18% with dividends. Art, maybe the biggest thing that happened this week as far as investors are concerned was something that was widely expected, and the Federal Reserve announced yesterday, on Thursday, that it was lowering interest rates by 0.25%.
Yeah, there's never been anything that was so expected to happen that had so little impact on anything. Everyone knew what the Fed was going to do. This is unlike the last time when they lowered rates in the summer, when there was some debate as to whether it was going to be 0.25% or 0.5%. And I think it's a recognition, and the reason the market didn't even react to it. They were too focused on what's happening vis-a-vis post-election, what's going to go up and whatever. And so I think this is the exclamation point for the fact that we've had or are having the soft landing. From here on out, what the Fed is doing is going to be methodically, as long as inflation stays low, as long as the economy continues to expand, as long as enough people are getting jobs, they're going to continue this methodical reduction of interest rates. So again, they're doing their jobs. They've done a great job. And the market didn't even flinch. I don't think there was any anticipation of anything different this week, and no excitement thereafter. Just the market was just another day on Wall Street.
Well, but it prospered. I mean, I just said, we went up 4 or 5% in all those indexes.
Yeah, but that was not because of the Fed. That was because of a reaction to the relief that we had an election that actually gave us a result. So the uncertainty vis-a-vis the markets disappeared.
Well,
The old saying.
let's talk about that a little bit. The election settled on uncertainty. We always talk about Wall Street not liking uncertainty. One big uncertainty was who was going to win the presidential election, and we found that out on Tuesday.
Yeah, I mean, for those who've been living under a rock, I mean, we're going to have a new president, same as the old president. I mean, I think part of the reason with the markets going up, I think it is a little bit of a sugar high, right? I mean, Trump's been running for president for now 12 years, roughly, and his one kind of core principle is tax cuts, right, for people, for businesses. So when he wins, you see people the markets go up because they realize, okay, he's either going to really extend these tax cuts or he's going to lower them even further, which can help companies' bottom lines, which obviously is going to help the stock market. And I just call it a sugar high because, as we all know, it's not linear, right? Like, even if you cut taxes for businesses and people, it's not just going to go straight up, 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 and up. But you combine kind of the upcoming tax cuts with where we are in the market now, with coming into the end of the year where you get your possible typical Santa Claus rally, you get your end of the year push, and then combine that with also what a lot of investors know is that November through April historically is usually some of the best 6 months for markets ever. So you combine that, and I think there was a lot of kind of enthusiasm to put some money back into the market, where initially, I think Tom has said this as well in other podcasts, there was so much money on the sidelines, some people might have put it back into, like, cash on the sidelines. So people might have put it back into fixed income. But now with kind of the change that they're seeing, they might have felt more comfortable to go back into stocks because that trying to get in early on what they see kind of coming down the line.
Yeah, thanks, Mike. So, yeah, Tom.
I was just going to say, I think what's really funny this week, and I had a client call me out to some extent on, how we often talk in our meetings, especially all year long, about how little elections matter. And then they see the markets go up, and they're like, I thought elections did not matter. I'm like, well, let's wait, right? So to Mike's point about the sugar high, concept is, I think that is very accurate. Right now it's the relief of the uncertainty. It's right now the trade is all speculative, right? It's financial surge, small mid cap surge, based on the ideas of some of these policies that may or may not go through. So it's nothing has changed. So I think that's really important, and why I say there's a sugar high, and there could be not a crash, but a sugar crash. To make sure I'm clear about that, but it's. The fact that, the S&P, earnings valuation is now at 22 times future earnings. We haven't seen necessarily earnings of companies surge at this moment, but prices have surged. So at some point, and another important fact is interest rates have gone higher. We've seen interest rates from a low over the summer of about 3.6 on the 10-year, now up to about 4.5. Is that the end, or is there more? And so these are all very important factors that the market's going to start to care about real soon. And if you're a trader, these are moments that you capitalize on. So that sugar high may wear off. So I think we'll still stand, at least for now, on the comments that elections, the moment, the event itself is little, can matter for traders. It's tradable. But is it something that you want to start putting eggs in one basket or another? I'm advising not to do that.
So the politics doesn't matter so much in the longer term. That's what you're saying. In the shorter term, we're seeing that maybe it doesn't. And Fed Chair Jerome Powell yesterday was making a point of saying that that policies that are advocated by one party or another, that they usually take time to get implemented, if they're implemented at all, and B, to have an effect on the economy. But they can have an effect, especially around the margins.
The politics don't necessarily matter, but the policies big time matter. Right. And when you come back to the sugar high, maybe we got an excessive amount of gains this week. Maybe they can dissipate slightly. But reading between the lines, we're talking about a whole different approach to antitrust, mergers and acquisitions. Bank stocks went up big time because there's going to be less regulation. of these potential mergers and things. So people are buying the market, expecting that it could be a golden age for business, and they could be right. Who are we to bet against that? So these are policies that could be happening. There's always some speculation. We're not going to jump in and throw a whole bunch of money in. Our investors are, balanced investors. We're making sure they're in the market. They were in the market before. They're going to be in the market after. We're not doubling down, now that the market just went up. But what happened to sell in May and go away, right? Anybody who did that hasn't done as well. And we're not suggesting, although several months ago when we were up 20% on the S&P, I said, hey, you could sell everything, buy a CD and end the year pretty well. Well, the S&P is now up 27% for the year. Well, so much for that idea. And it wasn't a serious suggestion.
I think people just say it because it's just fun to say, because they like the rhyme.
Yeah, maybe.
That's all it is. They
Maybe.
just like to
But-
rhyme things. That's all it is.
Yeah, but the other
Always
thing.
remember, never sell in November. Yeah.
I can't. I forgot that. But but the trick here is it's not valuations or how high price earnings multiples are. It's that investors are saying, and we talked about this earlier, stuff like Bitcoin that you can't even value using any kind of a metric. There's money on the sidelines that believes that something different is going to happen. That could also affect consumers who, despite the fact that they're complaining about inflation, might feel relieved, because perhaps their candidate got elected. So there are things that happen in the economy as a result of an election that can spur growth and cause stocks to go higher. So, I'm pretty excited about what's going on, regardless of which candidate got elected.
Right, and even before this week, there was basically a bullish sentiment toward the market, and the economy has been doing well.
Right. We overcame the old saying on Wall Street, a bull market climbs a wall of worry. Well, we have less worries. At least we don't have a fight over who won. And the only question going forward is, what are the policies going to be of this new administration?
But there will be more to worry about. There will be more uncertainty.
There'll be plenty to worry about.
Right.
Plenty
So
to
I'm
worry
going to
about.
give you one slight worry that I had that I read about this week. Slight worry. So I read through the Fed notes, and one part of the Fed's kind of what they struck out of what they said was, and I wrote it down, they removed a reference to gaining in confidence on inflation. Now, they came out and said it's not forward guidance for that, though. But I just kind of found that they struck that out, that for a very long time, I shouldn't say very long time, but for a while now, the thought process was, all right, we're gaining confidence that inflation is reined in, and they put it out there. And now just them striking that phrase out just kind of made me pause a little bit. And again, not saying, like Tom said, we're not going to crash. It's not going to be anything like that. But the removal of that phrase in their thinking just kind of gave me a little bit of pause of like, oh, and Tom mentioned the 10-year going back up. Is inflation going to kind of rear its ugly head a little bit and not continue to trend downward? Is it going to spike back up a little bit? If that happens, then maybe the market kind of processes things differently. But again, that phrase just kind of made me pause a little bit and kind of do a double take.
So the Fed was expressing optimism but not exuberance, and as always, they're being careful. And they said they're going to keep watching the data. They meet again next month in December, and there's speculation that they're going to drop rates another quarter of a point, but there actually is a higher percentage of people saying that they might not do anything.
Yeah, they might even go a little bit slower from now, because I think I saw some speculation that initially some people thought by the end of Q1 it could be around 3.25, 3.5 for the rate, and now some people are thinking it could be around 4. So they would still cut, just maybe not as fast, because it's, as everyone here said, the trajectory is different. There could be some different data points there. So it's just, for me, and I think all of us here, it's just kind of something to keep an eye on when kind of talking to our clients.
I feel I just to add, I appreciate Fed Powell's comments this week, because I felt like it was a very consistent, measured tone. He wanted to stabilize pricing in the markets and not throw it off by making a pivot based on the rate cut moves. So obviously the market expected that. That happened, and like I said, I appreciate the comments that he just said. The 10-year going up is possibly due to inflationary fears, but also economic growth projections, being higher. We kind of use the 10-year Treasury as more or less a proxy for where we see growth in the economy down the road. So I think it's important to kind of bring that to light at the same time, because that could be true. And it just highlights again that we don't know. We're in this, everything is speculative. is inflation automatic? Not necessarily. Or are these policies automatic? No, not at all. We just don't know. So, I mean, you dig down and just get back to the heart of what matters, interest rates and earnings and what we know right now. And those are very much intact. I think we've all been talking about it all year long about we have a very good backdrop and a very good foundation for markets and where our clients are at right now. So I'm still, keep a lot of optimism heading.
Let's talk about earnings a little. Are there things that came out this week? I think 91% of the S&P 500 now have reported their earnings for the third quarter.
And they're beating earnings estimates as they always do. But again, the market's, going up regardless. But again, different stocks have been going up this week. The bank stocks doing well, small and mid caps doing well because of their more domestic, focus. But back to your comment about the economy, normalizing. The real issue here is what is the neutral interest rate? That's what the Fed's getting at. When are we going to be at that point at which, we're there, if ever? Okay, but so I think we can expect short-term rates are going to continue to go down, and if we do have some concerns about inflation, and if the economy continues to grow, then that yield on the 10-year, as you suggest, could go higher. Because it's not that high, historically.
Should we expect rates to go back down to zero as they were for a long time? And remember, I remember when the Fed was struggling to try to, get more room in there.
Only if they have to stimulate an economy that's gotten weaker for some reason. I don't think
we don't have any evidence of that right now.
And we don't have any evidence of
Not
that.
shred.
Something would have to go terribly wrong.
I would be worried.
Right.
Yeah.
So it's nice not to be at zero in case something does or when something does.
They're in a good
go
place.
on.
They've driven this very nicely,
Well,
I think.
and think about it from the viewpoint of our clients and anyone who's maybe retired or cares about income. I mean, now I think we feel a little bit more confident, at least in the interim, that money markets and yields are going to remain a bit more elevated. I think that is, again, no guarantees, but I think we can feel a little bit more confident in clients, people who are income oriented from a fixed income standpoint of view. Those bond yields will stay relatively higher. The money market yields and CD yields are going to stay higher. So, another little positive to some of this higher rates, it doesn't mean it's the death knell for markets per se or valuations and how we reprice. There's obviously positives to this as well.
So getting back to some sort of a neutral rate and finding out what that is means being above zero, so at least your safe money, you're getting paid a little bit for it.
Right. But the question is, what is the right short-term interest rate so that you're not stimulating the economy and you're not slowing the economy? And so when you're at 4.5 to 4 3/4 or wherever we are right now, that's relatively high compared to inflation at 2%. So we as savers can make a couple percent with no risk, which is absolutely spectacular. And so it doesn't seem like they're, but it could restrain some economic activity. Some businesses might not want to borrow at 4.5. They might only borrow if rates drop to 3 or so. So that's why they've got to watch what happens to employment. If companies aren't hiring enough workers, then they've got to keep lowering rates to keep those workers employed. Right. But then the yield on the 10-year, as it's gone up ever since the Fed, I think September started to lower rates, the long-term rates have gone up. So mortgage rates have gone up from where they were. And that's because of concerns about long-term, or it's not necessarily concerns, because of the expectation that the economy is in a good place and will continue to grow, and people who loan money for long periods of time want to get paid, right. Especially if we're going to have a burgeoning deficit that's going to require more financing. So interest rates should be higher. The neutral rate, I think, should be higher than 1 or 2, maybe 3, and that's what we're starting to read about. So.
Yeah, I think from the Fed's point of view, I think a lot of people that, because they say the Fed's goal is 2% inflation, but you and I have talked about this. I think we're of the same mind. I think the Fed's going to try and settle ultimately around 3. That's just kind of my guess on because I think what that does is it leaves them room to go either way.
Yeah, I think you're right.
I think it leaves them room to go either way, where if they need to, if something goes wrong either way, they have room to lower, they have room to raise, and they're not necessarily boxed in by saying we have to get to 2. Because if they say we have to get to 2, I don't know how long that takes. And that kind of boxes them in, where I think they would like to have a little bit more flexibility, where if they get around 3, they can say, well, this is kind of neutral for where we are now. And then if they need to make a move either way, they still can.
But to clarify, I think the Fed should settle at about 3 for short-term interest rates. Sure. But I think we're already there or on the way to 2% inflation. So you have to get paid. You have to pay people something for something.
I mean, it's right now. I have clients that complain every time the Fed cuts because they are just absolutely loving the fact that they can get like
something
still
for nothing.
4.5% on some Treasury yields or something. They're like, why are we cutting? I'm making money on this. This is great, and there's no risk. And I'm like, you're yelling at the wrong person. I have zero juice over the Fed. I'm so sorry. So,
great. Anything else? Any other thoughts? Things you've been sharing with clients this week? Otherwise, enjoy the sugar rush and don't get carried away by it. And as Max said, thank the veterans for their service, and we'll see you again next week.
Thank you for listening to Money Talk with Bob Landaas. If you have a financial question you want answered on next week's show, email it to moneytalk@landaas.com. To keep informed throughout the week, visit our Money Talk page at landaas.com.